What's going on, guys? Mike here, and today is going to be a jam-packed video. I have a number of things we're going to go through, and I feel like I have to put it all in one video because it's all relevant. And I've missed a whole bunch of content this week because I've just had a cold and I haven't really wanted to record all that much. So we're just going to get right into it. So the topics we're going to be covering today are we're going to be reviewing the RioCan's earnings report that was just released. We're also going to be looking at SmartCentres earnings report that was just released. We're also going to be comparing my past month's portfolio performance to the mutual fund that I benchmark myself against, which is the RBF 460. And for those of you who are new, the reason why I like benchmarking myself against that one is because before I took matters into my own hands, RBC pretty much just pushed this balanced portfolio on me, didn't really explain it, that kind of thing. So if I hadn't taken matters in my own hands, this is the fund that I would be in. So anything I do better than this portfolio, or sorry, that fund, I feel like it's a win for me because, I took matters into my own hands and, started doing it myself. So we are going to introduce another mutual fund, which is the growth portfolio from RBC, which is RBF 459. And the reason why I want to include that one is because I personally, on the DIY side, don't include a whole lot of bonds in my portfolio, and the balanced portfolio RBF 460 has a lot of bonds. So this one is a little bit, less of a bond, but again, it still has bonds. But since it's their growth portfolio, I want to see again how we compare on the DIY side with ETFs, which are passively managed, against the actively managed mutual funds. And a little bit of kind of a sneak peek, I do have a little bit of an exciting thing where I have also moved my my locked RSP account into Questrade. So we're going to talk a little bit about that at the end of this video. So stay tuned and let's get right into it. So looking right at the portfolio measurement here of the last year to date, you can see my portfolio, which includes my RSP, which I had, was originally in the RBC RBF 460, and my TFSA, which is always started on the DIY side. So current year to date is 6.3%. And you can kind of see I also kind of revamped the structure as well. Whereas before it would say, VDY, but now it says ETF VDY, or it's a REIT PLZ, Plaza REIT, or REIT SRU, or REIT REI. So I'm hoping that it kind of just better organizes, and you can kind of see, because before my ETF with XEQT, it just said global ETF. Well, like, what is it, right? Which one are you using? So for you guys, I have changed it. So now it's like, if it's an ETF, it has ETF in front of it and which ETF it is. So you can see XEQT right now is one of my top performers at 8.8% of the year. Financial sector being Power Corp PWO being at 12% for the year, as well as TELUS being at 10.2%. So my biggest losers is Plaza REIT, which is funny because it's my favorite REIT. So yeah, they're down 5.8%. But you got to stay the course. This is just the way it is in the market, right? So I hope this is a little bit more better organized for you guys, and it also helps me as well. But like I said, 6.3% year to date as of last month. So that's not currently what's in this month. That was as of the end of last month. So 6.3%. Moving over to the balanced RBC fund, which is RBF 460, you can see here that its year to date is 5.2. So again, we're starting to kind of, the month previous they were kind of starting to catch us because of bonds, because again, this is a very bond heavy fund. They were starting to kind of catch us a bit, and it seems like it's kind of starting to go the opposite way, where the equities are starting to come out back on top compared to the bonds. So again, 6.3 versus 5.2. And the new fund that I'm just kind of watching myself again on the mutual fund side, which is the RBF 459, it as year to date has come in at 5.5. So definitely a little bit better than the more bond heavy balanced fund. But again, we still are on top of this one at 5.5 compared to 6.3. So I'm pretty happy with these results. And again, this is just kind of showing there's always these like a whole bunch of different portfolio mixtures, right? There's like your 100% equities, you got your 90-10, you got your 60-40, your 70-30, so on and so forth. So over the course of just being able to kind of visualize this, we're going to also be able to just kind of see how the different portfolios react in different different kind of time frames in the market, right? So my RSP, just so you guys are aware, is a 90-10, and my TFSA is 100% equity. So I am very equity heavy. So being at that 6.3, I would expect to be higher. But in really bad years, I feel like I'm going to go down a lot harder than these portfolios that actually have a lot more bond exposure. So moving on, we're going to go right into the RioCan's earnings report. So I feel like this one was a pretty good earnings report. The market, didn't respond in a negative way. It didn't necessarily respond in a massive positive way, but it still was positive today, as this is the first day after their earnings. So this is just kind of their scorecard. I just wanted to really quickly highlight that this is kind of what they're aiming for. And so far, they're all in the green statuses. As you can see, like their payout ratio after quarter one here of 2023 was 59.3%, and their goal is to continue in that range of 55 to 65%. And again, that is their goal also over the next 5 years. So again, they're all in that all in that green status, which is a positive. So that's just kind of like a really high level. They're just kind of getting more into it. You can see here their, like I said, their payout ratio. You can kind of see their previous quarter. So it has increased ever so slightly from 57.3 to 59.3. I don't necessarily see this as a concern. It's kind of expected with the higher interest rates we kind of have going on. I would expect their costs are kind of increasing, right? So again, though, I think they're really well positioned. A lot of these real estate properties, they typically try to line up the leases with like the mortgage expiries. So if the mortgage is expiring and the interest rates have kind of gone up, then the rent can also go up to kind of counter those increased in costs, right? Now, it doesn't always work out that way. Obviously, the life isn't always perfect, but that's typically their goal in a lot of these different real estate REIT companies. So again, I think that they're well positioned to kind of continue that. Kind of looking at RioCan, you can kind of see though over the last 5 years, there hasn't really been a whole lot of growth. If you were to have gotten in during the 2020, that would have been obviously the best time to kind of get a really decent return out of this company. So just a few things I kind of want to highlight here. You can see here that their net book value is $25. And for those of you who are new or haven't seen my other real estate REIT videos, I talk about how you can take their assets minusing their liability or their debt and dividing it by the number of shares in the REIT, which would give you the per share cost. So you can see here they're at $25 a share in theory with their net book value, and they're trading at the $20.38. So they're technically below market value right now. And you can kind of see here, right here, you can see last year they had 310 million shares, and now they're down to 300 million shares. So they're attempting to do a lot of stock buybacks to try to bring back up that cost, because right now they're a little diluted, maybe with too many shares, which is obviously driving the price down a little bit. So it is really nice to kind of see how they are purchasing back those shares to for the shareholders obviously to regain that capital appreciation back. So that's positive. So like I said though, out of everything that I can see here, that RioCan I think is in a really good shape, continuing through the year. Like I said, it wasn't like a massive positive in the stock market reactions today. They did kind of go up that 0.34%, which is great. There's nothing wrong with that. But sometimes when like the earnings report is really good, you can see like 2, 3, or even 5% increases all in one day. So that's pretty nice. As long as it's positive, I think we're obviously in the right direction, right? So the next one we're going to look at is SmartCentres. So you can see here they also are on the positive from the day at 0.82%. So just looking at their earnings report here, what I was kind of concerned about in my last video, which is this video here, that they were kind of running on a high. I think it was like 98% of their payout ratio. So you can kind of see here the payout ratio is at 93% without the adjustments. So it does look like it's coming down. So that is a positive. It's not massive or anything like that. They're still very high. There's obviously always a bit of concern when you are running in the 90th percentile of your payout ratio. So, you know, obviously this one is just to kind of continue to watch. I personally, like, if they were to lower some of their dividends, I don't think it would be too much of a negative thing. Like, they are paying out a 7.15% dividend, which is extremely high. I personally would, you know, be happy with that, like 5.5% to 6% dividends, you know, by them lowering their payout, and so that, you know, that extra capital can actually go back into, you know, the developments and not having to leverage as much. So we'll see what happens. They may not lower it, but, you know, RioCan did obviously do that. As you can see, you know, they are around that 5.3% compared to that 7%, so much lower, but I feel like this one's way more sustainable. Like, if you were to buy into this REIT, there's nothing really indicating of a concern, right? They're within the parameters of that 55 to 65% payout ratio, whereas SmartCentres obviously is a high payout compared to, you know, with being at a 93 percentile of their payout. So, you know, some potential concerns there, but you know, I don't necessarily look at it as a bad thing if they were to decrease that dividend. So yeah, just kind of finishing up with the earnings reports here. So there was that last part that I really wanted to talk about, which is I finally decided to make another move on some investments, and I decided to actually take my locked RSP, or maybe you want to call it a LIRA. I ended up moving it again from RBC, which was also in the RBF 460. And I actually moved it to Questrade. So I'm pretty much, I quite love Wealthsimple, but the downfall is Wealthsimple does not offer self-managed accounts on locked RSPs. So you can obviously do that with regular, you know, RSPs, but not locked. So I was kind of forced into either going Wealthsimple and having them manage the portfolio, or me moving it to Questrade, and so I can still continue to manage the portfolio. So if you're interested in knowing, I have $20,000, which I'll show in this screenshot here. So we have $20,000 that has now officially been moved to Questrade, and I will be making another video based on what I will be allocating that money to. So if you are interested, definitely be sure to subscribe, like this video, and so that way you get that future content and you can see where I will be putting that money into. So without further ado, I hope you guys enjoy this video, and I'll definitely see you guys next time. I'll catch you later.